If you're here, it's probably because a founder has sent you a link to this video because you're thinking about investing in their startup as part of their friends and family round. Now, if you're actually a founder and just interested in doing a friends and family round, I recommend you go to that video over there, which describes this whole process from the founder's perspective in a little bit more detail. Hi, I'm Lance Cottrell. I'm an entrepreneur who raised money from friends and family, and then later on angels and other investors, and took my company to a very successful exit. And these days, I'm an angel investor and actively involve early stage companies and startups. If the founder of the company you're thinking about investing in has already started to talk to you about this process, you may be feeling a bit overwhelmed by all the specialized vocabulary and technical jargon involved in these kind of investments. But the reality is it's really pretty simple, and the forms and contracts involved are very standardized. So I'm going to walk you through what that looks like and what you should be expecting to see. So hopefully you can go in with your eyes wide open and support your friend or family, the founder. You're being asked to invest in the founder's company, your friend or family member, at a very early stage. This round of investment is usually called the friends and family round, because typically only people who know the founder are getting involved. This is usually too early for professional investors or serious angel investors without a personal connection to be interested in the company. In this case, you are buying a piece of the company. This is not a loan, you're making an investment. And we'll talk about exactly how that works in a minute. But it is a critical phase of any startup. As an investor at this, what we often call the idea stage, you are allowing them to lay the foundation of the company and do those early things, hit those early milestones that will make them of interest to the later investors and set the company on its path to great success. So I'm going to start off by being kind of Captain Bringdown here and talking about some of the negatives of being an investor in a friends and family round, because I think you should be going in with a very clear idea of what you're doing. And the first reality is your money is locked up for a long time. Unlike stocks or bonds or mutual funds in the normal sense, those are liquid. You can buy and sell them whenever you want. When you buy equity ownership in a startup, you aren't allowed to sell it. You're basically stuck with that until the company either goes public on the public markets, it has an IPO, or until the company is sold to a larger company, which is the most common exit and can be extremely lucrative for everyone involved. But for most companies, the earliest exits that are positive are at 5 years, and the really best exits are more like 10 years. Until then, your money is stuck in the company. And so just be aware of that. Any money you're going to need in the short term shouldn't be invested. The other unfortunate reality is that most startups fail. At worst, they collapse and the founder goes on to get another job or start another company, but that investment has evaporated and your money's gone. Typically, that's like 60+% of startups. Many others sort of muddle along. They turn into what they call lifestyle businesses, but never really have an exit. Maybe there'll be an opportunity for the founder to return your investment, but again, probably in the very long term when the company is stabilized and in a profitable place. However, on the upside, this investment can pay off handsomely. If you put in several $1,000s into this idea stage company really early on, you're buying the company when it's not worth a lot. So proportionately, you're getting much more. If the company eventually has an exit, it's acquired for several $1 billion or goes public at $100 billion, that, say, $10,000 that you're putting in now could be worth tens of millions of dollars down the road. And really, that's the bet you're making. You are supporting your friend or family and hoping that they will make an enormous success, but always being aware that it might not happen. And if you're not comfortable with that, then being in the friends and family round really isn't for you. Usually, when you're investing at this early stage in a company, you're not actually buying stock. because stock is messy and complicated. There's a tremendous amount of negotiating to do. There's endless obscure terms that have to be part of the stock purchase agreement and go into the structure of the round and series of stock itself. That involves lawyers. It takes time. It takes money. And when a company is doing a friends and family round, it's largely because they don't have money. So it doesn't make sense to spend money on that. Normally what you are buying at this stage is something that will turn into stock. So right now, it is effectively a promise. At some future time, this will turn into stock. And that future time is when the company raises money from a professional investor who is buying stock. When they are buying actual stock, they have the lawyers, they will negotiate the terms. You get to piggyback on that deal and take advantage of that. So the company only has to do all this legal jiggery-pokery once. The investor at that point is working hard to negotiate the best deal, so that kind of guarantees that you get pretty reasonable terms. But normally you get a better deal than he does. So you'll get a discount or a cap on that. So you get rewarded for having come in much earlier than they did. The most common things that turn into stock are called SAFEs, which is an acronym for Simple Agreement for Future Equity, and convertible notes. These are loans that later convert into stock, but they're kind of a weird loan because they're a loan that is never intended to be paid back. The loan is sort of just a legal fiction and a placeholder to hold on to the money that you've given to the company before it turns into stock at the end of the day. Both of these share most of the same key terms. The first term is the conversion trigger. What is it that causes your SAFE or convertible note to turn into stock? And as I said earlier, usually it is a priced equity round when someone's coming in and buying stock. Often it's any time. The first time someone comes in and does an investment for stock, you convert. Sometimes the terms will be at some threshold. When they have total stock investments of over, say, $1 million, then everyone converts. You wouldn't want to see anything much over that, but those are both very common kinds of terms. In either SAFEs or convertible notes, you'll almost always have a discount, the amount by which you're getting a better deal than that investor that triggered the conversion event. So let's say your discount is 20%. So if that next investor is buying stock at $1 a share, you get to turn your money into stock at 80 cents a share. Or since usually investors are looking at this at valuation levels, how much the company is worth, effectively the new investor is investing at, say, $10 million. You get to invest at an effective price of $8 million. Company is effectively smaller, you get more ownership of the company per dollar than they do. Now, typically, discounts can run anywhere from 10% if you're expecting to bring in that next round fairly soon, up to as much as 50% if it's going to be quite a while. And that's there to reward you for taking that big early risk on your friend or family member. Most SAFEs and convertibles also contain a cap. That is a limit to how much the company can be worth when the conversion happens. And that's to protect you. So if it takes a long time for that next round to come in, let's say you invested and the company is probably worth maybe $1 million, but they're able to take your money and bootstrap for a long time, build up the company, and by the time that next investor comes in, they're coming in at a $20 million valuation. Well, if you had a 20% discount, you're now buying the company at a $16 million valuation. But wait a minute, you invested when the company was only worth $1 million. That seems like a pretty bad deal. And it is. It's a terrible deal for you at that point. So the cap says you're never going to get a worse deal than X. When you're at a friends and family round, that's typically going to be, say, $1 or $2 million. So if the next investor came in, let's again assume a 20% discount, if the next investor came in at a $1 million valuation, you're coming in at an $800,000 valuation. But if the next investor comes in at a $5 million valuation, you're not coming in at 4.5, you're coming in at 1, if that was the cap. So you always get the better deal, whether the discount or the cap, whichever gives the lower valuation, so the lower stock price, more ownership for you, whichever of the better of those for you applies, that's the deal you get. Sometimes you'll also see most favored nation terms, or MFN. What that means is that if someone else comes in with a convertible instrument later, after you did, and for whatever reason they were able to negotiate a better deal than you got, you have the option to take their deal instead. So it means that no matter what happens before the conversion event, you always have the best terms, or at least equal terms, of anyone else who comes in on the deal. Once you convert, now you own stock, you're locked in on the terms of that deal, and later investors are getting whatever they get. You generally don't get to change your deal after that point. So there are some slight differences between convertible notes and safes. The convertible note is, as I said, technically a loan. So when you give the money to the company, you will get a note back. So they now carry your investment as a debt of the company. And the note will come with interest, typically something like 10%. So if it takes a long time for that note to convert, you're now earning 10% annual interest until that happens. So in fact, you'll end up having slightly more money in the investment than originally. Usually this is not all that material, and so it's not something that I get too hung up on. You also, again, technically are a debtor of the company, right? You have, the company owes you money, and so if for some reason there's a liquidation or a bankruptcy, you are a debt holder. So in principle, you're going to get paid back your fair share of the company assets, depending on how senior a debt you are. The reality is you're pretty junior, and the assets they have. If the company is folding up shop, usually there are no assets. So while I say it's technically a loan and technically debt, and technically you have more protection because you would get money back, in reality, I almost never see that happen. If things go really, really badly, the company runs out of money and no one gets anything, no matter what kind of instrument they held. Another complexity is that convertible notes have durations. Like any loan, there's a term to that loan, at which point either it's supposed to have converted or the company is supposed to be able to pay it back. But let's say this is a 2-year note. In 2 years, if the company has not raised more money to be able to convert, it's probably because things are not going that well. They probably don't have the money to pay you. And if they did pay you back, it would be ruinous for the company. They need all of their assets to keep trying to grow. In general, you don't even want them to, right? You're hoping that they're going to be successful at some point. You would rather them take what little money they have left and continue to try to be successful rather than writing you some fraction of the money that they had at that time. And at this point, you need to negotiate because legally they have to pay you back. So now you need to come up with some other thing. You need to issue a new note, you need to convert to stock at that point, and now we're back to having to negotiate that and bring in lawyers. It can be messy. So while it does, again, provide that small bit of extra protection, personally, I'm not a huge fan of convertible notes, especially at the friends and family round. The SAFE is the simplest agreement out there and the most standardized. There's a big accelerator for startups called Y Combinator. And because they kept seeing all of these weird agreements all over the place, their lawyers sat down with a bunch of investor lawyers and created this standard document called the Simple Agreement for Future Equity. It's available on their website. And pretty much everyone just takes it, fills in the blanks, and uses it. There's no negotiation other than the terms that I described. There's no interest rate. And it is simply a legally binding commitment that the company will issue you stock at the agreed upon price, with a discount or at the cap, when the conversion event happens and defines the conversion event. So it may seem like a bit of a strange instrument, but it is what most deals are done in, all the way up even through professional investment rounds, right? You bring in a big priced round and then you need a little more money, what they call a bridge round. Even then, the venture capital companies are often going to be coming in on a SAFE because it's quick and easy and gets them to that next round. At the end of the day, the friends and family round is what helps the company get off the ground. You need money to make money. It costs to bring in resources, to get software licenses, to do all the things you do to get that company starting to roll and to be able to show traction and show success. And your early investment is so critical to the success of the founder that you want to help. it can be life-changing for them. The experience of being a founder and running a startup is an amazing journey. And even if it doesn't work out well, it is unbelievably educational and sets the founder up for much more success later on. In fact, most successful founders have been unsuccessful founders previously. In many cases, many times. But when things work out, it is life-changing for them in terms of money and knowledge. And as an early investor, could be life-changing for you. But it's important that you really understand what you're getting into, and hopefully this video has helped make sure that you're going into this transaction with your eyes wide open.